Good morning, Randy. Good to have you here. I know we have a very interesting topic to talk about today. You've been in the merger acquisition space for many years. You helped a lot of tech companies to exit through M&A process. So I'm pretty sure a lot of our audience would love to hear your experience, especially those who are building exciting companies and they're thinking maybe at some point in the future they will want to do an exit, which would be a big event, maybe the biggest event in their career lifetime. So it's important to know what the steps are and where to start and how to go through it so they can make the most out of it. So I'm very excited about today's talk.
Yeah, I'm excited too, and thank you for doing this. So my background is that I've built companies. So I've built a software company and a services company and exited both of those. One successfully, one was more of a learning experience, but you learn a lot from your failures as well.
Absolutely.
So I did that. Most recently, I stayed with the acquiring firm and helped them build an M&A team in North America. So we acquired 9 companies over the last 7 years. And now I've moved to the middle role. So I'm acting as an investment banker, helping tech entrepreneurs exit successfully. Because I am pretty passionate about the fact that entrepreneurs invest their heart and soul in their company. And I think if they deserve to have an exit on their terms.
Yeah.
And I'm hoping to play that role for the people who've worked so hard.
That's perfect. So, no, this is great. And where do we want to start? I know there is a process into getting ready for making your company sellable. You have to build it to be sellable. I believe that is something that we always discuss together, that the company has to be built from the beginning or at some point during its lifetime to be a company that somebody can buy it and run it, with or without the founder, maybe for a little bit with the founder, but eventually it has to be on its own operational. So that's so where do we start? What would be the
talk about it a little bit, because almost any company can be sold, but it's not worth very much if it's dependent on the founder doing all the work, because you're buying yourself a job. Right?
Yeah, exactly.
So one of the things that an acquirer will look for is how independent is the business as a business, right? So if the founder got hit by the proverbial bus tomorrow, can things still be sold? Can employees be hired? Can the product be delivered? How much of it is lives beyond them? And that's a really critical piece. And most companies go through stages where early on it is all the founder. And eventually they have to transition to a point where they're working on driving the business forward, not being in the business. And that's a hard transition. So that's one of the times that maybe it's time, or at least you're open and available to sell, is once you've got to the point that you're not doing all the work, and you've got teams that are doing the work on your behalf. Actually, we can talk a little bit about timing of the sale too, because I think that's, when to sell your company. It's a really hard question.
Yeah.
Right?
When is a good time to sell?
When is a good time?
Yeah.
And I'd suggest that there's sort of 4 big dimensions to this.
Yep.
And ideally they all line up, though in practice that doesn't always happen.
So
in the
real world, you don't have all the stars lining up. Sometimes, but not all the time.
Sometimes, yeah. So at the highest level, right, you want the macroeconomic conditions to be good. So you want to have seen the stock market goes up for 4 or 5 years in a row. You've got good momentum in the economy. What happens then is there's more confidence in the general business community. There's also, if there's IPOs happening, there's more money flowing into the various funds that might actually acquire you. So they have more capability. So at a high level, you want the economy to be doing okay.
The economy to be doing okay.
And then ideally the market you're in is doing okay. So if you're whatever vertical that you're working in, whatever segment you're in, if it's really hot, like if you were in AI for the last few years, or if you were anything with the .com in the 2000s, right? You have huge amounts of excitement, a lot of attention, more buyers and sellers, so you get kind of demand working on your behalf. So ideally, if the economy is good, your sector is really hot, your company has to be in good shape. And that's both financial.
So what does that mean?
Financially and structurally. So financially, you want to have had a couple of good years. You want to be driving solid profits. And for some tech companies, that's less important. For some tech companies, you want to have gotten your technology to the point you can prove it can work, and you're so far ahead of the rest of the world that you can exit before you actually start driving revenues.
Oh, okay. Right? So that could be a good time to exit too. Okay.
Yeah, and
nice. Before even getting to a huge profitability, or still the balance sheet is not as clean as you expect.
But you have to be really honest with yourself. What you have is true breakthrough technology that somebody's going to pay for, even though you haven't proven it in the market. Vast majority of companies, you have to at least demonstrate there's market demand and probably demonstrate profitability before the company's really in shape to take it to market. Does that make sense?
Yeah, it does. You have to at least have the first movers in that mainstream market that you are targeting, which are the pragmatic customers, some of them have made a move to adopt your technology. So it's not adopted fully yet in that mainstream, but it is kind of crossed the chasm in a sense, or it is about to cross the chasm.
Yeah, that sense of like you squeezed out the technical risk, like what you're doing doesn't defy gravity, it works. And then the commercial risk, people will actually buy it.
Yeah.
So you go through product market fit, and there's different terminology, but the idea is that an acquirer can look at it and say, okay, this is real, it works, and people want it, which are two big check boxes for a technology firm. Right? Now, if you're able to do all that while bootstrapping, that's really impressive because it means you retain control, you've been able to drive a disciplined organization, it also leaves you in charge. And maybe after we talk a little bit about the benefits of like bootstrapping and exiting versus raising capital, because that's a really important consideration. Yeah,
that's a very important one because that determines how long you can wait, or are you being forced to exit in some cases, which might not be the right time for several reasons, but the structure of the company and the shareholders and cap table could force you to exit.
Absolutely.
If I can guess, that would be an area.
And I'm happy to dig into that. But I don't want to forget the fourth thing, which is probably the fourth timing component, which is probably the most important and the least talked about and the hardest to define, is that are you ready as an entrepreneur to move on to the next level?
Mentally,
and are you aligned? Is your family aligned?
Yes.
Right? Are your stakeholders aligned? So it's very difficult to transition from being somebody who works 90 hours a week in a startup to somebody who has an awful lot of time on their hands, and there's only so much golf a person can play. So like having that timing lined up, so that ideally you've got like the market's great, your vertical's hot, your company's killing it, and you're at the point where you want to move on to a new stage of your life. If all four of those line up, then like you should be looking at going to market. Unfortunately, most companies, many companies are forced to go to market as opposed to choosing their timing.
Yeah.
And so I think preparing yourself thoughtfully so that you actually have an exit plan from the beginning will make your life a lot easier down the road.
So how many months or years you have to start putting these elements together, or thinking about it, and, for example, making the company to be self-sustained per se? How for a startup tech company who came up with some interesting solution to the market, let's think in that context, when would be a good timing for somebody to start putting these elements together and looking a bit in the future?
It's tough to give a universal answer because technology varies so dramatically.
For sure,
right? So you look at some of the most recent AI-driven SaaS firms, right, which are developing quickly, and they're going from like $0 in revenue to $1 million in recurring revenue in 6 months. So that was unheard of 3 years ago. That's happening now. So they might be in a position to exit more quickly than historically has been the case. Right? But I will say that generally speaking, you look at something like 3 years to get yourself to a position, like fastest case from like startup to being in a position where you're ready to exit. It usually takes that long to get the technology. Some of the technology is faster, but to get the market running and to build a company usually takes something like 3 years. With my previous caveat. The other thing I'll note is if your company has been running, and the average company that sells has been running for 14 years in the tech space.
There you go. So that was my thinking that, in a super hot market, cases that, for example, the AI space these days, maybe we can, at least for the sake of this discussion, call them as an outlier cases. But the cases that I would like to mostly, focus on are the cases that they have built a genuine technology product, but it took, as you said, 5, maybe even 10 years or more, still, like making money, and it's having, like a footprint in the marketplace. But how they can get prepared to be exits for the sake of the company and for the sake of the shareholder.
And so it's funny because that 3-year number comes up again. Ideally, you start planning to exit 3 years before you go to market.
There you go. Okay.
So if the average company sells in 14 years, you want to be looking at it at 10 years, 11 years, because a lot of stuff is just technical that you have to do. So you have to prepare to be transparent to an acquirer, and that requires having an awful lot of paper. It's virtual now, but fundamentally the paperwork done. So you have to have your financials, probably audited. Maybe you can get away with a notice to reader, but you have to have a credible track record of doing that. You want to have your tax structures in place. So if you're looking at minimizing your own personal tax, there's some things you can do, but you have to do them early. You can't do them at the last second. So that's important. And on the other side, if you're an entrepreneur who's perhaps a little aggressive with putting personal expenses into the business, you want to stop doing that 3 years before you sell, because The acquirers don't really want to help you with your taxes. They want to acquire a company.
Company,
So
right?
there's things like that, and then just weird detailed things. Like you have to hang on to all of your non-disclosure agreements and be able to have them available. And I can tell you, when we sold our company, Nonlinear, I was going through an awful lot of mailboxes trying to dig up all the
NDAs,
all the NDAs from the past, and every employment contract,
employee contract, and contract,
all your supplier contracts, and that kind of thing. So there's a whole bunch of things you need to do to get ready. Some of them also are like legal, like you want to try and change your contracts so that there's no, it's called a change of control provision, so that they will continue even if you sell the company. And some clients will push back on that. So having those conversations early, you're worth more to a buyer if they know those contracts will continue with no discussion, as opposed to them having to renegotiate with your clients after they acquire you. So there's a long list of things.
Makes it more valuable and more attractive for somebody to pay a more premium price for you. Which brings us to the discussion. I know we talked about it before we started the session, that how we go about the valuation and what is enough for the person who is exiting and all that. So it's an interesting topic, a sticky topic. I know we don't like to talk about money too much in our lives, but it's important, I believe, in this particular context.
Well, you have to know, right? So if you're an entrepreneur, and let's assume you're in that model where you've been running the company for 14 years, you've been running a real company, you've got clients, you're generating profits, you've got a pretty good lifestyle. So what you have to decide is, for yourself, what's the number I need to walk away from this financially? And that's a conversation worth having, like with your family, with your spouse, with any other stakeholders you have in your life, to really understand, like, what's my number right, that I need? That's step one. Figure out what you need. Do that with the right specialists to figure it out. The second piece is figuring out, like, realistically, what's your company worth? And I will tell you that the leading cause for deals not getting done in M&A is unrealistic valuation expectations by the selling founder.
By the selling founder, okay.
This is actually a bit less true in tech companies than it is in the broader M&A environment. But nonetheless, it's really important you have a realistic expectation of valuation. Otherwise, you spend a lot of time and energy and just not be in a place where you can get a deal across the table. And let me just talk for a second about the impact of raising investment here, because it has an enormous impact on your outcome.
Yes,
and for sure. It's really worth thinking about. So I know the story we're told, and it gets all the publicity, is that it's the Silicon Valley model. You start a company, you raise friends and family round, and then maybe you get a seed round, and then you raise a Series A from a venture capitalist firm, and then a Series B from a venture capitalist firm, and now you're a unicorn, right? That's the model. So something like 99.5% of companies in the world don't raise any venture capital, right? And shouldn't. For most,
it's not the game for them to play. It's a fair play, a game to play, but not for everybody.
It's really important to raise capital if you've got a unicorn-like market opportunity and you need the capital to grow. But for most founders, most of the time, raising funds doesn't work out. So that the number works out to about 75% of founders that raise venture capital exit with zero equity at the end of the day. So that's partly because 75%.
75%. Wow. That's three-quarters.
Wow. And there's two things happening here. So one is that failure rates are high in startups, right? We know that, so that's not surprising. But the second thing is that venture capitalists tend to have provisions in the contracts that make sure they get paid first. So
they have
there's non-dilution, there's a bunch of different mechanisms they can use. What it means is that they're protected. And even if you sell the firm for a pretty good price, if it's not a unicorn price, you may find that all of the dollars are going to them.
Because they have a preferred share or whatever, the different class of shares in the company. That's almost always they get that, right?
Yes. And so if that's the case, then you find yourself, you're no longer in control of the company. You may not get paid out. You have to question whether or not that's the right path. Like, you'd much rather own 100% of a $10 million company than 10% of a $100 million company, because Class A, you're in control, right? It's your firm. You make the decisions, and you keep all the equity in the company. In the second case, you may be a much larger firm, but you probably won't have control. You'll certainly have other stakeholders you have to pay attention to, and you may not find yourself walking away with 10% of the value if you sell. So that's a really important consideration around valuation.
Very important to know.
That it's not in the best interest of VCs to talk about, but it's true.
Yes. So going after VC is okay if it's truly the game you want to play, and you have to know what situation you're getting yourself into before you really go out. So what is the alternative to that? Like, okay, any entrepreneur will argue that for me to get the things off the ground, I need some capital. A lot of them are maybe just out of school. They don't have any sort of a capital on their own to inject. into the company in the first year or two, or even maybe longer before it starts to bring some money in. So what would be the alternative so that the company is built properly and it's worthwhile to exit at some point in the future?
There's a couple of bootstrap models, right?
Yeah.
And there's more than a couple, but I'll talk about a couple. So one is you have an idea. In software, you can usually get something done before you have to spend a lot of money, right? You can write it yourself, you can get some traction in the market. You're basically investing sweat equity, right? Build something so that you've got something, don't invest cash in it. So you use that, and frequently then, especially if you can get it to market in some form, MVP, prove that it works, get a few dollars coming in, you might look at raising some seed money or some angel money. And I think that's actually that's a wise thing to do. I think angel money is very different than venture capital money.
Yes.
And I think it enables a much different kind of outcome and more control from the founder. So I'm certainly not dissuading people from pursuing that approach because I think it really does help.
Especially those angels who understand you and they have some connection beyond just the financial transaction with your company and what you're doing.
Absolutely. In an ideal world, like they understand the problem you're solving, they can introduce you to people. You know, they're probably at some point in their life have been successful and they can bring their knowledge to bear on your company. I think that's a really helpful step. And then ideally, if you can do that, you get to the point that you're actually generating revenue, got some profits, you look at debt financing to move forward too, right? So you borrow money from government institutions, BDC in Canada or the small business in the US. You know, you look at the banks and you can use that to kind of scaffold it up. You won't go as quickly as if you raise capital, but again, you retain control. So that's one model that you see fairly frequently work. And it does, I think, benefit the entrepreneur when it works. The other model is to start a services company. So begin with a services company. Most of the time when you're selling your services, you get paid upfront or you know, close enough that you can make payroll, right? So you kind of start selling something you know how to do to somebody who will pay for it. And they pay you for that, and now you get some money in the bank. You do more of that, and eventually you hire 3 people to do it, and now you're doing services. The hard pivot then is to, once you've got that going, is to return to the product idea and build the product. Most companies fail to get out of the services mode because it's hard, because you've always got somebody who's willing to pay you.
You can't say no to them and go
as opposed to having them focus on the product. But if you do that successfully, and some of Canada's biggest companies that did that, Cognos, which you probably don't remember, but it was they kind of invented business intelligence back in the 90s and sold to IBM eventually. They were Canada's second largest tech firm at that point in time, and that's exactly what they did. They very deliberately sold services, found a problem and a client to solve, turned that into a software product, became a publicly traded company. So it's
a lot of companies did that. When I think of even HP started like that.
Did they? Okay, I didn't know that story.
Like they basically would take some jobs from here and there and do more like a building one-off of kind of a solution for their clients. Even like an automatic flushing tool to flush toilets or the boiler and things like that, right? So they started with those kind of more maybe not a pure service, but it wasn't a go build this product and then make a lot of those repeat sales of the same product. But eventually they got to that point and they grow. We know this story, right? The huge company.
So there's a model, and I do think that bootstrapping has a lot of advantages, right? It's hard. I don't want to. Like, it is difficult. You're always going to be short of cash. You're never going to pay yourself a lot of money, especially in the early years. You're almost certainly going to run into a moment where you have to make payroll and you don't have enough cash. Like, it's almost like
you should be ready for those days and those moments too. Right?
At least emotionally, right? Because it is like it's always going to be kind of crisis mode in the early years of a bootstrap company. But you do retain control. It is the way that the vast majority of companies happen, and people don't believe that, but I encourage you to drive down the street and look at every barbershop and restaurant that you see, because I guarantee they didn't raise venture capital money, right? Like that's the way that most companies function. And in the technology space, I would suggest that what's happening with AI-powered coding makes this easier to do than it used to be. You don't have to hire 30 people to build a product. A very small handful of people can do a whole lot right now, and that's going to change everything in the next few years.
Interesting.
So I think that's bootstrapping will become a more common model, I suspect, in software development.
Which is a good thing to hear, that because, as you said, chasing after the VC money, if you're not built for it, or you're not truly the company who is meant to raise VC, you could waste a lot of your time chasing and not even being successful to raise any meaningful capital, let alone if you do, that could also come with some strings
challenges. Plus managing the investors, right? Like once you've got a huge percentage of the CEO's job is going to be managing investors once you've raised venture capital. Well, that's a big chunk of your time not building the company.
Yes.
Right? And that's
That
So
could
there's a
take
whole
lot of
factor
your
there
time,
around
right?
distraction, right?
Yes.
And it's a tough trade-off. But I think you'll see that my guess is that venture capital will become less critical for high growth startups in the next few years.
That's a very interesting insight. That's music to my ears in that case, because my own journey of building companies, it matches a lot with the way you describe it, and I know firsthand the challenges goes with that.
Yeah.
But anyway, that should be a way to go for a lot of startups or young entrepreneurs who are getting out of school and they want to build their own company. It shouldn't be the default that, okay, let me go and pitch to VCs.
Yeah.
That's what I guess
Yeah,
at the end of the day you're trying to say.
Yeah, because the narrative you hear
Yeah.
is around the Silicon Valley model,
Yeah,
right? But
yes.
it's really rare that it actually happens. And so, right, you might want to think about the other world. And the Silicon Valley model produces enormous successes, but also a lot of failures. Because venture capital forces you to swing for the fences, right? They need you to be a 10-time, 100-time return on investment.
Yes.
Whereas you might be very happy just having a 5-time return on investment if you own the whole thing, right?
Yeah,
so,
of course.
Right,
especially if you know your number, as you said, and you know that if you get that number, your family and yourself, you're going to be happy, financially independent, which is a big thing these days to be to get at. And if that gets you there, especially if you're still in a younger age, that could be the best thing that can come out of. So if you kind of summarize everything, so you're building a good company, you know it has a unique solution or product in the market, and you get some market traction, and you manage to get there without getting too much burdened by the institutional investors per se, that they would determine or you forced you to for a super growth paths that might not be viable or could kill you, as opposed to take you to the next level. All that. So now, like to summarize, what would be the idea to get ready and sell and exit in a way that the process doesn't disappoint you per se, and you get out of it and happy, and you can start something new after that.
Yeah, it's a really.
So what would be the
really
summary of that?
Yeah. So have your company ready to sell, right? So all the technical things done.
Yeah.
Right. Make sure they're in place. Make sure you know what you want to do next, so that you're able to be prepared emotionally for this, and your family's prepared. Make sure that the funds that you generate from the sale is enough.
Yes.
Right. So we often talk about life-changing money.
Yeah.
I will say life-changing money for you is very different than life-changing money for a venture capital firm. Right?
Yes. So, of course. Yes.
Right. So like make sure that you've got, but understand that, right? And then understand the market. So have a realistic expectation of the value of your company.
Yeah.
And there's a few ways of doing that, and I'll just very quickly run through them because that's a whole topic in itself.
Yeah.
But most commonly, people look at public companies and say, okay, this company is like us. It's publicly traded, and they're trading at 18 times revenue.
Yeah.
So we'll trade at 18 times revenue. Well, that's not true. Public companies trade at a much higher multiple for many reasons, partly because they're larger, and larger companies have higher multiples, but also you can trade them. They're public.
They have access to capital much faster,
and there's liquidity, and there's also for investors
liquidity, of course,
right?
That's
huge. Private
yes.
company, you're locked in. So I would suggest that if you're doing less than $20 million in revenue,
don't go
there. Well, you can take that number, divide it in half.
So
if they're trading at 18, think of yourself as trading 9 times.
9 times.
All right, like that's probably it's shorthand. It's not super.
Yeah,
accurate,
just in a
exactly.
like just basically.
So that's one way of looking at it. The best way is we can find private companies that are sold in your space, comparables. Really hard to find that information.
because the numbers are not public.
Only about 10% of deals have information released, and unless deals are big enough to be material to the acquiring company, and the acquiring company is public, there's no reason to announce the numbers. So why would you? So even public companies that buy smaller firms don't announce them. So it's really tough to get direct numbers. So you are stuck a little bit in understanding that. And then there are traditional financial metrics you can look at too. So cash flow analysis, how much is the cash you're going to generate over the next 10 years worth to an acquirer. And these are standard ways that people do valuations historically for firms that are non-tech firms. And my suggestion would be that you do a few of these yourself. You can go online and find the information to do them. They're not terribly difficult. It's just math if you have the numbers. The private company multiples, you can find some references from places like PitchBook or CB Insights, and they will give you a few dots on the graph. They give you like the range of what you might be worth. So you'll probably fall in that range. Maybe you'll be much better. Maybe you'll be much worse. But probably
ballpark.
You'll be in that range, and that at least gives you a sense, right, of whether or not the value of the firm is worth it for you to go to market. So that's a long way of saying like you need to be ready. You need to know your number, and you have to see if your company's worth that.
So then at that point, do you recommend working with a so-called a broker?
Yeah.
Example,
So
that would do some of these, legwork per se for you, or at least get you buyers
yeah,
lined up.
maybe let me explain my
Yeah.
journey and sort of the process we went
Oh
through.
yeah,
I
that
think
would be
it's fairly clear,
Yeah.
fairly common. So Shannon Ryan, my business partner, and I started and built nonlinear creations for 23 years.
Yeah.
We started in '95 as an internet company, back when no one knew what the internet was,
Mhm.
including us. So we got there first. 23 years later, we were about 150 people, Canada, the US, Brazil, the UK.
Wow.
Our not so secret business strategy was to sell to people in US dollars and British pounds and pay people in Canadian dollars and Brazilian reais. Right? So
back then there
company.
was a difference in the exchange rate.
Yeah, absolutely.
Yeah.
Some years not, most years yes. So that worked out, right? We decided that after 23 years, it was time for us, both personally and all those things. That the market was good, company was good, our vertical was hot. We decided to go to market. So we hired an investment firm to do that.
Yep.
It was fine. The firm did their job. They weren't best in class, and historically, if I could do it again, I would spend a lot more time choosing my investment banker and less time kind of getting excited about selling the company. So I would have talked to a lot more investment bankers, done a lot more interviews. Because, well, we got a great deal. I'm not sure that we were best served by our investment banker. But if you're a sizable company at all, I think you need to have a professional help you take this to market.
Yes.
Because the burden is so tough for a founder to take on.
Yes.
You only do it once.
And they have to run the company in the meantime too. You cannot stop the whole operations and look for a buyer and do all that.
Absolutely true. Like
that's
just, like I counted, we exchanged something like 6,000 emails during my selling process, right? And that's with a broker helping me. And so ideally an investment banker or a broker will help you do a bunch of things. Make sure your company's ready. Make sure you've honed your pitch so that you know exactly what the value of your company is when you sell the company as opposed to your product. You're probably really good at selling your product. But selling your company is a
different thing. You haven't done it before. You have sold your product many times, a lot of times, but never sold your company. So you are pretty new in that particular space, right? So it's good to have
and they should help you really nail down your pitch. And that's there's a few different pieces. You're gonna have to the elevator statement. You're gonna have to have a 20-minute management presentation, and they should really a big part of their job should be making sure those things are rock solid and really compelling before you get to market. They should be able to get you in front of buyers. So there's a very large universe of buyers for tech firms right now. Many are non-traditional buyers. You're seeing all sorts of weird pivots. So agricultural firms that decided they now want to be in the technology space, or very large retailers.
Is that because of a surplus of cash they have, or is that they're diversifying?
Sometimes it's strategic, right? They've decided we no longer want to be an agricultural firm. Sometimes it's because there's a lot of funds chasing very few deals. That's particularly true in private equity. There's a lot of funds. So it's just what you don't want is the obvious buyers. There's going to be 4 or 5 obvious buyers for your firm, but you want to make sure you can reach that really broad audience.
Open the net a little bit.
Because what you want to have is competition. Competition will drive valuation.
Of course, yes.
So that little cloud of where the valuation sits, you only get to the top end of that if you have multiple people wanting to buy your company, right? You desperately need it. If they desperately need it, you might get above that, right? So the idea is to get the right players at the table, and that is the job of the investment banker. So it's a combination of them having a great list, but also great relationships with the people involved, both strategics, so companies that are like yours or in your space, and then financial buyers like private equity firms who are very, very active. In the last 12 years, have actually been paying more at the median for tech firms than strategics.
Is that true?
It is. It's
That's interesting insight to know.
Yeah.
Typically, you expect the PEs pay less.
You would think so,
but
right?
they have the money to pay and kind of do the transaction.
There's almost $3 trillion of private equity funds that have not been deployed, and they have to give those money back if they don't spend them. Or the equivalent. So they're looking. So there's an awful lot of demand, right, and supply. We're building private equity firms faster than we're building companies they can buy. So there's demand in the market. Now the average is higher for strategic buyers because there's a handful that get sold for 300 times multiples, right? Because they're truly strategic. But
the total amount,
a median, they're very competitive in this space. So all let's say your investment banker needs to understand that space, have relationships, understand the market. So it's
so choosing that investment banker is the important one. Not every broker is the right one for you.
Make sure they understand your vertical. I personally really prefer firms that have a focus in a given vertical, not somebody who sells anything to anyone. There are different opinions on this, but I think someone who really understands your market's critical. And then they have to help you. They should help you through the negotiation and due diligence.
Due diligence process.
This will be the first time for most entrepreneurs you've done this.
Yeah.
It's really hard to get good at something if you don't get any practice reps in, right?
Yeah,
so doing it once is really tough.
Yeah.
You want someone who's been through the process
and
before,
knows how to do it, and with the less friction and faster.
And can guide you on whether or not this is a good buyer, whether this deal makes sense, because it's not just the dollars, right? It's the structure of the deal. It's how much liability you need to retain post-deal, the tax structure. There's a lot of things go into like getting an optimal deal that are not about the top line number. Your employees, what's going to happen to your team? Do you care about that? If that's critical to you, you need to have an investment banker who can make sure they reflect that and find a buyer who will take care of your team.
Right.
As an example.
There's a lot of stuff there that I know in some cases the seller has to get part of, or maybe a good portion of his payout contingent to the future revenue, and that becomes a challenge, because you never know what's going to happen a year or two after your company is part of a larger organization.
Absolutely true.
Those things are important to have your banker to really maneuver through it, and at least be clear with you about what you're getting into.
Yeah, and
nice.
Let me say a few more on structure, because I think it's under-recognized in the market. So there's two things people don't talk about: structure and liabilities. Right? They talk about the top line number they see. So structure is basically how you get paid, and so in some deals, 100% cash on close or publicly traded stock. Right? So you walk away. That doesn't happen that often, but it does happen periodically. Right? And that's kind of ideal for the seller. The buyers generally don't like that. Because they want you to assume some of the risk of future growth. At the opposite end of the spectrum, you might have an entire deal based on an earnout. So you don't get any funds up front, but if you're able, if you tell them you're going to be worth $20 million in revenue in 3 years, they'll say, okay, great. If you hit $20 million in 3 years, then we're going to give you a whack of cash. Challenges with that is there's lots of risk. There's market risk. There's risk of integration. The firm acquiring
management and everything.
You don't have control.
Change of focus. They might not even focus on the vertical you are in.
They might be promising you their sales team will sell your product, but you don't control that sales team. Right? So, and you're not the only priority they have. The new CEO, there's a whole bunch of things that can happen. So earnouts are risky, right? At the opposite end. And so what you usually see is some blend of the two. And an investment banker should be able to guide you to a model that works out best for you. I would suggest that the seller, you think about whatever you get up front.
That's the number. That's got to hit the other has to be icing on the cake.
Exactly. And
if it happens, that's good. If not, you're not in the loss.
Yeah.
So, yes.
And again, that's a really tough call to make if you're just doing it on your own, because you've got no context. Right. You've got no comparables. And the last thing I'll say, I think an investment bank should be able to introduce you to key professionals that can help you. So your current business lawyer may not be the right lawyer for a large M&A deal. It's a very specialized knowledge, especially if you're selling cross-border. It's common for Canadian firms to sell to U.S. companies, right, or European companies, and recently Asian companies. So you have to understand law in at least 2 jurisdictions, maybe 3. You have to have tax specialization. So it's a different group of specialists than you've worked with to run your business. And the investment banker should be able to bring those into the party.
Okay, no, that's great. So to take away for me, from an entrepreneur perspective that doesn't think about these things every day, is that it's a very serious and delicate process. Don't think that somebody will show up and give you money and take your company like a cookie. It is going to be a very demanding process. So get ready and get educated about it and start to putting elements together. If you're ever thinking at some point you got to be exiting and earning some return for the work you did. So is that a fair?
I think the firms that benefit successful exits generally require preparation. And thoughtful preparation. Right. So many entrepreneurs will tell you they get inbound phone calls, people wanting to buy their company. I can guarantee that's not the best offer you're going to get, is that firm showing up at the table, right? Because they're looking to buy like under market, cheap, quick. I've seen numbers from the Quorum Group that suggest that if you go to market after you've had an initial offer, the final offer is 50% higher, 48% higher than what that initial offer is, right? So by introducing competition to the deal, even if that same company buys, it's still 48% higher. So yes.
Because you create competition, and that raises your value.
So you want to be thoughtful about going to market as opposed to
being reactive to somebody comes and offers something to you, and you want to fall for that. Right?
Yeah. You sometimes hear people say that they want to be bought, not sold. But that's actually not a great idea because you'll be in that first scenario where somebody's showing up to buy you, but you don't have the competition or the structure or the process. You haven't designed to sell. It's like having selling a company is a bit like selling a product. You build it to sell it.
Build it to sell it.
Like
there you go.
Do what you need to do to sell it. So that's my perspective in any case.
Perfect. No, this was great, Randy. Is there anything else you want to? I know there is a lot to talk about. Maybe there will be another session. We can dive into some of those more delicate topics that we might not have the chance to cover, in details. But anything for this particular session that you want to add to? It's already been very valuable for me, and I'm pretty sure our audience will benefit from it.
The only thing I might say is that make sure you think about the entire spectrum of potential buyers. Because what happens, I think, is that it's very easy to think, okay, we're in this business and our buyers are these 5 or 6 companies that are bigger than us in the same business.
They're going to buy us out.
But there's a whole bunch of different models. So you've got the strategic buyers, which are those groups that will probably acquire whose names you probably know. Maybe you don't, but they're in the same kind of industry or adjacent industries, usually. There's those groups. There's the financial buyers, and we talked a little bit about private equity.
Private equity.
Right? They've got a lot of pressure to spend those dollars, and they're very competitive. And in that model, they're going to ask you to stick around. They're not going to buy your whole company. They'll buy maybe 75%. You're expected to stay and drive it to the next level. So for some people, it's a really good fit. But there's also new structures like search funds, and this is where an entrepreneur goes and raises money to go out and find a company which he or she is going to acquire, and then drive forward. So basically, your company continues as it is with a new entrepreneur driving it forward, which maybe if you care about your legacy is a really good model. And you've got somebody who,
you could be very earliest stage in that model and still be bought out.
Absolutely. Right? And I think that's a really interesting model too.
Yes, I didn't know about that model.
You know what? It's been growing very quickly since about the last 7 or 8 years. And it's an alternative form. Technically, it's private equity, but it's a very different model.
It's a different model,
right?
Yes.
And I think it's really, really smart. And you're also seeing it in non-tech businesses where people are trying to buy their way into entrepreneurship. Rather than doing that hard part where you go from $0 to $100,000, they want to buy a $100,000 company so they can take it to the next stage. So it's open not just in tech. And then the final thing I'll say is around sort of traditional exits. So sell it to your employees or your management team, right? Sell it to your kids. And depending on the kind of technology firm you build, those might both be options, right? And so, employee share ownership programs are now available in Canada. If depending on the kind of firm you've built, if it's 30 years old and you've been doing IT services for 30 years, that's a viable option that may in fact check all your boxes around your financials, keeping your team together, keeping your legacy together, and of course, selling to your children has been traditionally what companies have done, entrepreneurs, but you got to make sure your children want the company.
They want to run it.
There's a big disconnect, I can tell you, between founders who think their kids want the company and kids wanting the company. Those are not the same thing. Have that conversation early and often, not at the end.
But that could be an option for some group of the companies that are more traditional businesses with a profitable year-over-year business. They can use that path to
absolutely.
Exit, right?
Look, at the end of the day, tech businesses are still businesses, right? They have different dynamics because of the speed with which a software company can grow and because of the profitability profile of software companies. And all other technology companies. But at the end of the day, it's more money in than out.
It's a business at the end, and in principle, it's a business creating profit. So we have to look at it from that perspective. Right?
And so if you've been doing this for a while and you're successful, then there are lots of options on the table that aren't just selling to Microsoft, Google, Amazon.
Right. So go out there, be successful, and be ready for an exit so you can make the best of it.
Perfect.
Randy, thank you so much. I appreciate your time. Thank you.